Hey guys, welcome to another training for Lion's Mane Tax Advisory Services. This training is in response to a lot of questions I get about, hey, what are these business things? What kind of structures can I have? What are the tax benefits and what are the liability benefits? Because those are two entirely different categories. And then, frankly, the back half of this video is going to be an S-Corp cheerleading video, basically selling you on the concept of being an S corporation as opposed to literally anything else. And then we can, of course, talk about how we will implement that into your personal strategy. Basically, after you've watched this video, if you like it, let your advisor know if they haven't already talked to you about being an S Corp, and we will make it happen for you. Without further ado, business entity structures, navigating the landscape. All right. So, introduction to business structures, we have four primary ones that we're going to talk about today. You have limited liability companies, you have corporations, DBAs, and partnerships. So partnerships are kind of the oldest, all the way back to two human beings agreeing to work together to do something, whether it was build a cabin. That is technically a form of partnership. All it takes is an agreement and two people going into business together. Now, from the IRS's perspective, a partnership is when two or more people are coming together to work on something. The profits and losses all go onto a Form 1065, so that's a partnership tax return. So a partnership does exist in the eyes of the IRS, and it doesn't so much exist entirely in the eyes of the state because both partners are liable for what the partnership does, unless you go into a limited partnership. We're not going down that rabbit hole for this video. A DBA is one person. The example I like to give is a plumber. My name's Nathan. Hi. I'll say I'm a plumber today, right? So if Nathan the plumber wants to go work on somebody's house, I don't really want to say, hi, hire Nathan. I'm going to say, hey, hire Nathan's Plumbing. So I can fill out a form with the state and then get the name Nathan's Plumbing registered, and it will be tied to my social security number. And then along the side of all of my trucks or whatever, I can write Nathan's Plumbing. People will write checks to Nathan's Plumbing, but ultimately, if I bust a pipe and water goes all over somebody's house, I am liable for what happened because Nathan's Plumbing doesn't actually exist as a technical corporate entity, and so if I get sued, it's me. I'm getting all the liability. People can come after my assets. Okay, so then you have two semi-similar things. As far as things went in the past, the next to be created was a corporation. So the concept is, hey, I want a thing that is totally separate from me, and we're going to call it a company or a corporation, right? And they have some semi-negative tax implications because there's a corporate tax, but we'll talk about that in a little bit. But they are totally separate. They fill out an 1120 corporate tax return. Your DBA and sole proprietorship kind of stuff, that's all going straight on your personal tax return, your social security number. Even if you have an EIN for your DBA, it's still going on your tax return. There is no DBA tax return form. And then last, a limited liability company is kind of a hybrid between a corporation and a DBA. So from the state and liability perspective, we'll talk about that in a little bit. But for the IRS perspective, it doesn't necessarily have its own tax form. If you're a sole proprietorship, you're the only person in that LLC. All of that stuff is just going on your personal tax return, just on a different form. So I'm not going to bore you by reading everything on a slide. You can always go back, pause, zoom in, do whatever reading you want. But this is basically just outlining the different levels of liability protection for each of these entities. And again, I don't claim to be an attorney. I don't have any desire to be an attorney. You can get specific details on just how protected you are from liability from your local neighborhood attorney. We do have partnerships with several law firms, so we do have connections for you if you would like to talk to somebody about that. But what we're really here to talk about is the IRS's perspective. So again, we said sole proprietorships, they don't really exist. They just flow straight onto your personal tax return. You have self-employment tax that you get hit with. Partnerships have their own forms called 1065s. That's a partnership tax return. Corporations are an 1120, which is a corporate tax return, and then that LLC being kind of a hybrid, right? So maybe the LLC is a sole proprietor, or maybe the LLC is a partnership, but an LLC kind of doesn't exist from the IRS's perspective. They don't care about it unless you turn your LLC into an S-corporation, which is what we're going to talk about in a second. An S-corporation is a pass-through entity, so money comes in to the corporation, the S-Corp, right, and then it flows straight through to the owners, of which there can be up to 100. Instead of getting money into the corporation, corporate tax, and then dividends to the owners. So we'll talk about that in a second here. Okay, so we're starting to dip our toes into this concept of an S-corporation, right? So how do I make an LLC? Again, this is something we can help you with here at Lions Main Tax, and something we do a lot. So first step is you need to have a corporation or an LLC. We can only make that S election all the way back up until you form the thing, and there's some other requirements for that, but we won't go into the details. But the important part is if you're running around under a DBA, you need to go tomorrow and open up that LLC. It's S-Corp Insurance, because as soon as that LLC is open, we can make it an S-Corp. So highly recommend you go and form that LLC as soon as possible. Once you have that made, you're going to fill out a form, a 2553. If you're making a late election, so you didn't do it in the first 3 months of your existence, there's some other steps that we have to take. Again, something we're very used to here. And then we have to make sure that you're eligible to be an S-corporation. So you can only have 100 shareholders. Nobody can be a foreign investor. So somebody from the UK, for example, can't be a shareholder, right? And then you can only have one type of stock. So not going to go too deep into those specific things or what they mean. But the important part is, hey, are there 100 or less people involved in this thing, and is anybody not a U.S. citizen? If the answer to both of those is no, a double negative, then you're eligible to be an S-corporation. We'll file the form, and congratulations, you're an S-corporation. Why does this matter? So you're not getting hit with the corporate tax rate, which was 21% at the time of this video, and then paying your FICA and your federal income tax and all of that jazz. And then beyond that, it has a significant benefit of lowering your self-employment tax. So that's the FICA that we're going to talk about in a little bit. Some kind of cons, if you will. They're a little bit complicated, which again, here, let me move myself so you can see. You do have to have payroll going for the owners of your S-corporation. So critically, you need W-2s going to the owners and officers. And then also you have to carefully balance how much of your profit is going on to those W-2s to the officers. And you'll understand here in a second why we want to balance that. So let's say we have a company that's made $50,000 of profit. What they're first going to get hit with is FICA, or Social Security and Medicare. And that, at the time of this video, that's 15.3%. I don't think that's ever going to change unless they get rid of Social Security. So on our $50,000 example, that's $7,650 of FICA. Okay, now we're going to get charged 17% of what's left. So that's going to be $7,199.50. You say, Nathan, where'd this 17% come from? Obviously, our tax system for federal income tax is tiered, right? So 10% in the first bucket, so on and so forth. Nominally, it ends up being about 17% for most higher income people, but we're going to just say it's 17% for the sake of the math. That doesn't so much matter. So net, your take-home pay after paying both those taxes is $35,150. That's $14,800 of taxes, almost $15,000 of taxes, just because you made $50,000. So we don't like that. And you also might be saying, hey, well, what about deductions and this and that and the other thing? I'm not talking about that. I'm talking about, hey, after you've done your deductions, after you've done all the things you can do, this is money that you, no joke, put in your pocket, right? And you went and spent it at Walmart or whatever, you know. So now we've got to pay taxes on it. That's what we're talking about. Now, if we do make an S election, we get to do this really cool thing where we put some percentage to the right on a W-2. So like we're going to be employees of our business. In this case, we're doing 50%, so that's $25,000. And just like the last example, the entire right side of the screen is the exact same. but we're dealing with 25,000 instead of 50,000. So you get hit with FICA, you get hit with your federal income tax, and that contributes towards your take-home pay. But what's really cool is the S-Corp being a pass-through entity, right? This 50% we put over here on our pass-through side, or K1s, you're not paying FICA. All you're paying is your federal income tax, right? Which notably is a little bit more because you're not getting hit as much. But that ultimately is bringing up your take-home pay by over $3,000. So now your total taxes are $11,675. I'm rounding up. That's almost $3,200 of savings just by making an S election. And it didn't necessarily cost you anything to do that. So that is why we always recommend S elections to people as long as they're making $45,000 or more. And you can see right there, there's $3,000 of savings. And then the really cool part about this is as your profit goes up, we can justifiably lower the percentage that we're putting onto our fair compensation to our officers. So as profit goes up, this percentage goes down, and this percentage goes up. More pass-through flows straight into your pocket, and you're paying slightly less in FICA. Obviously, when this number goes up, this number will go up too, but these percentages are going to drop, and your savings will increase significantly the more money you make. And where you're putting these percentages, that's what we do. That's our strategy and how we can help you make sure you're hitting those wickets correctly. And that's kind of the hardest part about all of this, determining fair compensation in the eyes of the IRS. We actually have a matrix that we use with a law firm that we've partnered with that tells us, hey, for this much money, this is the percent that we need to put into the W-2, and this is the percent we can pass through over on our pass-through K1 side. So again, the more money you make, the more sense an S election makes. And then I do have a disclaimer. I put my little asterisk there. All of this math, is correct, sure, but what about the payroll, right? So if you're, for example, doing payroll with us, it's at the time of this video like $100 a month or something. It might be more in the future, might not be, we'll see. But $100 times 12, that's $1,200. So that is kind of coming out of your savings, if you will, right? But no matter if you're making $50,000 or $300,000, it's still $12,000 to do payroll. So net, you're saving $2,000 after you pay your payroll expenses. Still, $2,000, you're winning, right? And that's why we say 45 is the sweet spot. Anything less than that, the juice really isn't worth the squeeze. The amount of money you're saving may not be worth it. But more than that, absolutely, we're going to do S-Corps. And if you haven't already heard about the S-Corp from your advisor, just shoot us a note and we'll have a meeting with you about whether or not an S election makes sense for you. And do us a favor, please don't watch this video and then go make everything an S-Corp, because that isn't necessarily the move either. We want to have really just one S-Corporation in everyone's life, just one. If you have more than one S-Corp, you're paying double in payroll fees, and you don't need that. So we're going to restructure everything separately. That's a topic for a different video. If you have any questions, just reach out to your advisor. Thanks.